Markets don't fear bad news. They fear what most people haven't noticed yet. Most investors are trained to watch the headline, a rate decision, a jobs report, a geopolitical flashpoint. But the market's real stress signals often show up somewhere quieter, in the plumbing. How trades settle, how liquidity moves, how contracts get honored, and how operational systems hold up. Here's the uncomfortable truth. When a market is healthy, it can absorb shocks in public. Prices move, spreads tighten. When a market is fragile, the first thing that changes isn't the price, it's confidence in the mechanism. And in 2026, that mechanism has a new vulnerability: operational fragility and cyber risk. Government agencies have warned of sophisticated nation-state campaigns targeting critical infrastructure. That doesn't mean collapse, it doesn't even mean crisis, but it means the next move is about whether the pipes still flow when everyone reaches for the exit. Now let's step away from hype and establish what can actually be treated as fact. Over the past several trading sessions, precious metals markets experienced unusually sharp price movements and widening regional price differences between futures centers and physical markets in Asia. Gold and silver futures traded with elevated volatility. While futures prices adjusted rapidly, physical market quotes in Asia reflected higher premiums for immediate delivery. Physical bullion markets showed tighter availability and higher local demand. Meanwhile, reported weekend delays were simply due to standard exchange reconciliation and maintenance. The widening in premiums occurred over days, accelerated by heightened uncertainty when demand for immediate delivery rises faster than logistical capacity. Importantly, exchanges remain operational and no official declarations of default or force majeure were issued by major clearing institutions. These events indicate operational strain, not insolvency. What we observe is shifting market structure, not a system failure. At this stage, we focus on observable behavior. Next, we examine why these developments matter. Price moves alone rarely tell the full story. What matters is how and why those prices move, and what secondary effects follow when market mechanics are stressed. The first-order effect of widening spreads between futures prices and physical premiums is straightforward. They signal that immediate delivery is being valued more highly than deferred settlement. This typically occurs when buyers place a premium on certainty, not necessarily because supply has vanished, but because timing, logistics, and risk have become more important than price alone. The second-order effects are more subtle and far more important. When spreads widen, arbitrage activity normally acts as a stabilizer. Professional firms buy where prices are lower and sell where they are higher, compressing differences. However, arbitrage depends on confidence in execution, confidence that contracts will settle as expected, that logistics can be arranged, and that capital can be deployed without unexpected friction. When uncertainty rises, whether due to operational delays, regulatory complexity, or heightened counterparty risk awareness, arbitrage capital tends to step back. That withdrawal alone can allow spreads to persist longer than models would predict. Another key consequence is liquidity redistribution. Futures markets remain liquid because they require less capital and no immediate handling of physical goods. Physical markets, by contrast, are constrained by transportation, customs, vaulting, and financing. When demand shifts toward physical certainty, liquidity migrates unevenly across the system. Prices in one venue can adjust quickly, while others lag. This matters most for participants with leverage or delivery obligations. Hedgers, refiners, and industrial users rely on predictable settlement to manage risk. If they perceive higher uncertainty in delivery timing or cost, they may preemptively reduce exposure, increase inventories, or shift hedging strategies. Those defensive actions can amplify short-term price moves without indicating a structural breakdown. It also matters for investors because pricing benchmarks influence everything from ETF net asset values to margin requirements. Wider spreads increase the importance of understanding what price you are actually exposed to: a futures reference price, a regional physical quote, or a blended benchmark. Crucially, none of this requires a failure of the financial system. Markets can function, and historically have functioned, with stressed plumbing, uneven liquidity, and temporary dislocations. But during such periods, price discovery becomes less efficient, and volatility can rise faster than fundamentals alone would justify. The takeaway at this stage is not alarm but awareness. Spreads, liquidity behavior, and operational frictions often lead headlines. They tell us where risk is being repriced quietly before it becomes obvious in the index level or daily closing price. To put this into perspective, we need to look at history, not for predictions, but for context. Periods when physical premiums diverge from futures pricing are not new. What matters is understanding how those episodes developed, what they signaled at the time, and where the comparison breaks down. One relevant parallel is 2008-2009, during the global financial crisis. Futures markets in precious metals continued to trade, but physical premiums rose sharply in certain regions. The cause was not the disappearance of metal, but a breakdown in confidence and logistics. Credit tightened, transport slowed, and dealers prioritized balance sheet survival over arbitrage. Futures prices reflected financial stress. Physical prices reflected delivery risk. Another reference point is March-April 2020, during the initial COVID shock. Gold futures and physical markets temporarily decoupled, with significant spreads between New York futures and London spot pricing. Refinery shutdowns, flight cancellations, and vault access restrictions created bottlenecks. Exchanges remained solvent, but the system took weeks, not days, to normalize. Importantly, prices did not move smoothly, they repriced in jumps. A third, more localized comparison occurred during regional capital controls in emerging markets over the past 2 decades. In those cases, local physical prices often traded at persistent premiums to global benchmarks. What is different this time is not the existence of spreads, but the backdrop. Markets today are more electronically interconnected, more leveraged, and more sensitive to operational confidence than in prior cycles. At the same time, regulatory frameworks, clearinghouse capitalization, and transparency standards are significantly stronger than they were in earlier crises. Equally important is what history does not show. In past episodes, extreme narratives often emerged before outcomes were known, claims of missing inventories, imminent defaults, or permanent system failure. In most cases, those claims did not materialize as described. The system adjusted, sometimes painfully, but it adjusted. History, then, serves as a filter. It reminds us that stressed plumbing does not automatically mean collapse, and that markets often look most fragile before stabilization mechanisms engage. It also reminds us that outcomes are rarely binary. Markets do not move cleanly from normal to broken. They pass through periods of friction, uncertainty, and recalibration. With that perspective in place, the appropriate next step is not prediction, but structured scenario analysis, thinking in probabilities, not certainties. That brings us to the scenarios. At this stage, the most disciplined way to think about markets is not in terms of certainty, but conditional probability. Outcomes depend on how liquidity, confidence, and policy responses evolve. In a bull case, operational frictions ease and confidence returns. Recent price strength could persist, particularly in precious metals, as arbitrage activity returns and spreads compress. The base case assumes continued volatility. Spreads narrow slowly as demand cools and uncertainty becomes familiar, aligning with historical precedents where stress in plumbing produced sharp moves without systemic failure. A bear case involves a confidence shock. Forced deleveraging becomes the dominant driver, liquidity thins, and prices can fall sharply across asset classes, even if fundamentals remain intact. None of these scenarios is inevitable. Professional risk management focuses on monitoring which conditions are emerging, not on betting on a single narrative. When markets are volatile, discipline comes from watching the indicators that transmit stress through the system. A strengthening dollar tightens global financial conditions, signaling stress-driven demand rather than broad-based inflation hedging. Treasury yields matter. Rising real yields increase the opportunity cost of holding assets like gold and silver. Markets respond to changes in the expected policy path. These expectations feed into liquidity conditions across all asset classes. Sustained moves supported by rising open interest suggest conviction, while forced adjustments often indicate price instability. Bid-ask spreads and market depth provide early warnings. When liquidity deteriorates, price moves tend to overshoot fundamentals. The goal is calibration. Understanding how stress is transferred, markets signal strain in small, technical ways first. At this stage, the most disciplined way to think about markets is not in terms of certainty, but conditional probability. Outcomes depend on how liquidity, confidence, and policy responses evolve. In a bull case, operational frictions ease and confidence returns. Recent price strength could persist, particularly in precious metals, as arbitrage activity returns and spreads compress. The base case assumes continued volatility. Spreads narrow slowly as demand cools and uncertainty becomes familiar, aligning with historical precedents where stress in plumbing produced sharp moves without systemic failure. A bear case involves a confidence shock. Forced deleveraging becomes the dominant driver, liquidity thins, and prices can fall sharply across asset classes, even if fundamentals remain intact. None of these scenarios is inevitable. Professional risk management focuses on monitoring which conditions are emerging, not on betting on a single narrative.